Hi guys, you're welcome to my YouTube channel. If you're new to this channel, kindly hit the subscribe button and turn on the notification bell to be notified whenever I drop any video. So in this video, I don't want this video to be long at all. I want to just quickly explain to you guys the POI you need to look out for when it comes to trading the financial markets, trading synthetic indices. The POI you need to look out for. I have explained this POI in my previous videos, but I think I really need to make a video on POI again, based on popular requests from my subscribers and then my viewers. So I need to make a video as regards POI. Now, whatever POI you're going to be marking out, ensure that that POI has taken out liquidity. What do I mean by this? If you're going to be marking out maybe a primary point of interest, a secondary point of interest, make sure that that POI takes out liquidity. Make sure that that POI takes out liquidity. That is what is going to help you to determine if that POI is valid or not. And when market gets to that POI, don't just jump into the market and just enter the market anyhow. Wait for an entry confirmation. I am always saying this, guys. You cannot always predict what the market will do, but you cannot go wrong with entry confirmation. So you really need to wait for entry confirmation, see the reaction of the market at that POI, and once you see that it is valid, once it has given you different confluences, you can enter the market. Don't just jump into the market anyhow because you feel it is a valid POI. Don't trade what you feel, trade what the market gives to you. Trade what the market gives to you. So when we talk about POI, like I said earlier, make sure that the POI you are marking out takes out liquidity. And aside from taking out liquidity, make sure that that POI carries fair value gap, meaning it carries an imbalance. The POI you're going to be marking out, make sure it carries an imbalance. So I'm going to be giving you an example of this. So we had this movement to the downside. Check this out, guys. We had this impulsive movement to the downside. You can see that the market moved impulsively to the downside, so we need to look out for a POI. We had a break of structure to the downside here. Remember, you are always looking out for the structure of the market before you mark out a POI, so that you can know if you are marking out your demand zone or you are marking out a supply zone in the market. Know the structure of your market. So the structure is to the downside here. So we had a break of structure to the downside here. There was a break of structure to the downside. So what we are looking out for is a supply zone that is very valid. That is a POI. So we are going to be looking out for the candle. Now we have primary POI, we have secondary POI. I'm going to link the video of the POI in the description box. I'm going to link it with it so that I don't want this video to be so long. You don't have to complicate matters for yourself. So like I said, it has to take out liquidity. So where is the liquidity that this place took out? Where is the last liquidity? Where is the last place we had a takeout of liquidity? You can see market gave us, you can see market gave us this is a liquidity takeout. This is our first liquidity takeout. This is our second liquidity takeout, which is the hunt of liquidity. This is a hunt of liquidity for us. So as soon as the market breaks this particular low, you know that we have a break of structure to come and take this low. So after the market has taken this low, where is the POI we need to look out for? So yes, our POI that we need to look out for around here. Now you need to check the 4 hours time frame to be able to see if there is a candle you can pick out on the 4 hours time frame. Luckily enough, we have a candle here on the 4 hours time frame. So you just pick out a candle here. This is a candle, and then you can see that we had an imbalance to the downside. We had a take of liquidity. So this is a candle that we can actually mark out for the market to come back into. So we can go to our 1 hour time frame again and see how the market reacted at the POI. So when markets got to that PO high, you can see the markets gave us a minor break of structure, which can be best seen on the 5 minutes time frame. So that's why I had to narrow down to this 5 minutes time frame. We had a minor break of structure, which is an intent for the market to start going down. So this is it. We had this minor break of structure. We had this change of character, rather. We had this change of character. And like I always say, you can enter in 2 ways. You can enter the market in 2 ways. If you have a good account size, your first entry can be here. Immediately the market broke this low, you can enter for first entry. Then if you think you don't really have so much to risk, like someone like me, I won't really enter at this point, I will not enter at this point, what I will just do is wait for the market to come back into this area. We had an impulsive movement here also. So on the higher time frame, I know this is actually okay, this is actually our internal structure. All this place is our internal structure, and then we started having this impulsive move right from this area. So when market gets here, it is very possible I enter at this area. I would have just entered at this area, placed my stop loss above this high. Now if you also enter at this area, your stop loss should be above this area. If you also enter around this area, your stop loss should be above this area. Now you can see that this first entry, you have a little high SL. But for this second entry, the SL is kind of tight. It is a little bit tight compared to this first entry. So that is just what you need to do. So let's look at another example. Let's look into another example. I'm going to be checking the 1 hour time frame. So yeah, this is okay. Let me just back this. Now we have this break of structure to the downside, and as you can see, the market has not really gone back into the internal structure. The market didn't really go back into this internal structure. Now immediately we have this break of structure, what I am going to be thinking is, okay, where will market reverse? Where was the last place the market took out liquidity? So we had a take of liquidity, which means a hunt of liquidity here. You can see the market took out this trend line liquidity. This is a trend line liquidity, and it gave me as hunt of liquidity. So the first area I'm going to be looking out for is this area, this particular area. I'm going to be looking out for this particular area. Now as you can see that the market did not get to that area, so my second area is this. That was why I had to analyze this area, because we also had a break of structure. Now if market breaks this area, that is when I'm going to be looking out for the market to come to this area. But market did not break it, it respected the area here. So that is just how you pick out your PO high. So here we do not have a break of structure to the downside. What we had was a break of structure to the upside. Now here is it. We had this break of structure to the upside, because market took out liquidity here. With this high. So meaning this high is a valid high. It is a valid high. Once we break this high, it is just our break of structure. That simply means it is our break of structure. Now after we had this break of structure to the upside, where is your first POI? I entered for a buy around this area. Because there was a valid area at this point. So where is the valid area? This is the valid candle. You can see we had a take of liquidity to the downside. I'm going to show you that on 15 minutes time frame. Now this is it. We had this liquidity take to the downside. The market took liquidity and then it started buying. So when market comes back to this area, I know that I'm going to be entering for a buy just to clear out this high. That is if market gives me a confirmation, because we still have a valid area here. So I entered the market at this point. Yes, I entered this market. I entered for this buy, and then I made sure that I cleared this high before I took my profits. Immediately it's cleared this high, I took out my profits, because we still have a valid area here around this low. We still have a valid area. There's still a valid area here. Now when market got to this area, my normal PO high was this low, this particular low, which is the SC candle, but market did not use it. Market instead used an area here. Now you can see we had this hunt of liquidity, market hunted liquidity. We had impulsive movement to the upside, which is a fair valued gap. This is a fair valued gap to the upside. So when market is coming back to this area, it's definitely going to react at this area. So when market broke this high, and then came back to this area, I took this sell also, though I took this sell very late because I was waiting for a confirmation. The market gave me a confirmation around here. I had a confirmation to the upside here, then I joined for the buy here with this particular candle. I joined the buy with this particular candle. After we had a break of that high with this particular candle, I joined the buy, and then I took my profits at this high. So that is just how you analyze your PO high. You look out for the area the market has taken liquidity. You look out for the fair valued gap. If the market actually gave an impulsive movement away from that PO high, then you patiently wait for the market to give you an entry confirmation. That is just how you pick out your PO high. It is not so hard. I mean, trading is meant to be simple, and then you really need to keep it simple. You don't have to keep it complicated. That is just how you pick out your PO high. Alright guys, that's going to be all for this video. Keep living in the atmosphere of profits. I'm going to see you in my next video. Bye guys.